In my last video I looked at annuities and said that I'd be following up to that by remaining on the guaranteed income pension theme and focusing on final salary schemes. There are still millions of final salary pension scheme members, 3.73 million to be exact, according to research by the Pension Protection Fund. And there are loads of different rules and quirks to these schemes that can make it difficult to decide how best to take your benefits. So how do you compare the options and find out what's best for you? Well, I'll come on to that in a minute. But first, let me help you make sense of some of the jargon you might see on your statement. That's probably a good starting point. And by the way, if you like the sort of content that aims to simplify all areas of retirement and personal tax planning, don't forget to subscribe and turn on your notifications. So, first of all, a final salary scheme is what's known as a defined benefit arrangement. The benefit you receive when you retire is a defined proportion of your salary. The terms tend to be used interchangeably, but defined benefit can be used to refer to any type of scheme that provides a guaranteed benefit of some sort. So it could also be a career average earnings scheme. The alternative to defined benefit is defined contribution. The benefit is not defined, just the contribution that you pay in is. That covers personal pensions and non-guaranteed workplace pension schemes. But if we look at a typical annual benefit statement from a final salary scheme, perhaps this type of thing will look familiar to you. Mention of guaranteed minimum pension and numerous lines with different annual income amounts shown. So what's this all about? Well, starting with guaranteed minimum pension, GMP, this is something that's linked to being contracted out of what used to be called SERPs, the State Earnings Related Pension Scheme, which was an additional top-up to the basic state pension. Many will remember that you used to be able to contract out of this arrangement, which meant either paying a lower national insurance rate or having a percentage rebated into a separate arrangement. Now, these GMP benefits accrued when contracting out via a defined benefit pension up until the 5th of April 1997, when they were replaced by another scheme. And the idea was to provide a minimum level of income broadly equivalent to what you were giving up from SERPs. To confuse matters though, GMP benefits are subject to different rules depending on when they were accrued. So you'll often see your benefits segregated into pre-1988 and post-1988 GMP. GMP benefits that accrued between the 6th of April 88 and the 5th of April 97 have to be increased in line with the Consumer Prices Index when they're being paid to you, capped at a maximum of 3% per year. GMP that was accrued before those dates, though, doesn't have to be increased when in payment. And that's why you'll see it segregated by dates. Your GMP benefits will also be revalued every year before you start to take benefits. And if you're an active member of the scheme still, this will usually be in line with national average earnings. However, if you left the scheme before you retired, because you changed jobs, let's say, you may also see reference to limited rate revaluation, where the scheme's liability for increases is capped and the state picks up the difference, or fixed price revaluation, where benefits you accrued up until leaving are revalued by a fixed percentage based on the date you left the scheme. Apart from what I've already mentioned though, the key things to remember about GMP are thus: no tax-free lump sum is payable from GMP benefits. They're for income only. The scheme has to make the benefits available from 60 for women and 65 for men. It is technically possible to access them from 55 currently, but usually only with the scheme's permission. And if you're married, there has to be a widow's pension of 50% of the scheme member's GMP rights. It's worth noting though that widowers and civil partners only receive the same entitlement on post-88 GMP benefits. They don't have any rights on pre-88 benefits. You may also see reference to what are called Section 9(2)(b) rights on your statement, or they're sometimes referred to as reference scheme test or post-97 COSR benefits. These also relate to contracting out of SERPs or its successor, the state second pension, and they just refer to the scheme that replaced GMP from 1997 onwards. Now again, these may be further segregated into different date ranges based on when different legislation was passed. This legislation affected how benefits were revalued every year prior to being paid and how they increased every year while in payment. Rather than give you all of these dates now though, which trust me would make your head spin, I'll pin a comment below listing all of the main dates and the changes that took place for you to refer to. The key differences between Section 9.2b rights and GMP, though, are that benefits have to be available from age 65 for both men and women, and more significantly, tax-free lump sum can be taken from these benefits. Benefits that accrue through your own or through your employer's contributions are usually listed as excess benefits, and any further entries on your statement that reference different date ranges that don't tally with what I've listed below are probably down to when your scheme itself implemented a change of rules. A very common thing for a scheme to do was change its normal retirement age. When you first joined, you might have been able to retire on full benefits at age 60, but with increasing longevity, most schemes realised they weren't going to be able to sustain that going forward. So they changed the minimum age to 65. Some have changed again since to align benefit commencement with the state pension age. But what this will have done is drawn a line in the sand where benefits accrued up to the date of change are preserved under the old rules, and those accrued after are subject to the new rules. The reality that this creates is that you'll probably have lots of different income figures on your statement, but hopefully this explains why and what they all relate to. The quirks and nuances don't end there though. You may also find when you come to start taking benefits, you're given options to do things like taking a higher income from the scheme initially and then seeing it drop down when your state pension commences. And you have to work out whether that's in your interests or not. I'll come on to how you can do that shortly. But another important note on the subject of the state pension, you may find that your state pension is affected if your scheme contracted out of SERPs or S2P previously. I won't even begin to explain the rules because this video would be an hour long. But if you're interested in learning about it and how you might be affected, I've put a relevant link in the description below. The biggest thing that will impact the amount of pension you receive though is likely to be the tax-free lump sum you choose to take. It won't always be the case because the lump sum on certain defined benefit schemes, usually public sector ones, accrues separately and doesn't affect your income entitlement. The most common method though is via what's called commutation, giving up some of your income in return for tax-free lump sum. And even schemes that work on a separate lump sum accrual basis may allow you to do this as well, to top yourself up to the maximum 25% lump sum entitlement. Your scheme rules will stipulate what the commutation rate is, and will show it as a factor of 1 to a larger number. A common one used to be 1 to 12, which means for every £1 of income you give up, you get £12 of tax-free lump sum. Obviously the higher the big number the better, because it means you're getting more lump sum for less income. And probably the biggest decision to make is, should I take a lump sum at all? And if so, how much of one? Because the more I take, the less income I'll get. And even though I'll be able to invest my lump sum for growth, that's then my risk. Whereas my income is guaranteed to increase every year. So how do we work out what's going to provide the best value for our own specific circumstances? Well, let's have a look at that now. The first thing we need is some sort of tool to be able to perform calculations and provide forecasts. So that could just be a spreadsheet. If you've got really good Excel skills, you'd be able to create a model for yourself completely for free. Alternatively, you can seek advice from a professional advisor. Quite often, if you're in an active employer scheme, there'll be an appointed scheme advisor who should be able to help, and there'll usually be some funding provided via your employer to do that. That might not be available to you though if you've got a deferred scheme from an old employer. It is, however, still possible to seek separate independent advice, or you can use a specially designed forecasting tool like I'm about to show you. This is the software that I use with all of my clients, not just for assessing defined benefit pension options, but for creating all financial plans. If you are interested, I've put a link below to how you can access it and then schedule one-on-one sessions with me or one of my team to provide guidance and sense check your figures. But how do we actually use forecasts to inform us of the likely best course of action? Well, whether you're creating your own projections on a spreadsheet or using the software like I'm about to show you, the first thing you need to do is identify the components of your pension income on your benefit statement, which I explained earlier, and enter them as separate income sources in your projection rather than just entering one overall income amount. The reason being, all those different components are expected to increase at different levels in the future. What we can then do is create different projection models that show what our future income might be. Here, for example, we assume that no tax-free cash is taken, and we can see what the income might be at any point in the future, assuming 3% annual price inflation, and the various revaluation and increase factors applied to the different elements of our pension. Hovering over the chart allows us to get an indication of what our pension income may be at any point in the future, and how much we may need to make up out of other assets in order to meet our expected expenditure. We can also see what our projected assets might be worth in that scenario too, using conservative growth rates that we're able to choose. What we can then do is compare that with what our income might be if we took the maximum lump sum available. So here, for example, we can see that there'd be an influx of capital in the year we retire, which could then be invested. And even though the yearly pension amount would be less, and more would need to be drawn from other sources to meet our expenditure target, we can compare the future assets projections to get a sense of which scenario leaves us with the most capital. Here, for example, if I hover over age 70, we can see we have considerably more projected wealth, having taken the lump sum and invested it, rather than taking the higher income. And if we skip right forward to the end of the timeline, that gap is projected to increase even more. Now, these are only projections, of course, and they're not guaranteed figures. You must always understand that. And everybody's situations and needs will be different. But by testing and comparing alternative scenarios with different levels of income and lump sum and different inflation and growth rates, we can make more informed choices based on reasonable assumptions. The more complicated your benefit statement may appear at first, the more useful this exercise becomes, because you're able to compare different scenarios side by side in a clear and easy to understand way. I've had clients who've had all sorts of options to choose between, such as the ability to take a higher income but forego inflation increases in the future, as well as various permutations of tax-free lump sum payments, and their heads have been spinning. But this exercise breaks it down and makes it clearer. Like I say, you can do this sort of thing yourself with a spreadsheet, and that will definitely help. There are many resources online that will help teach you how to format a spreadsheet to make forecasts, and even turn those forecasts into charts and graphs for easy comparison. There are, in fact, lots of videos teaching you how to create cash flow models on YouTube, and although most of them tend to be geared towards business forecasting, the functionality you learn would largely be the same and could be applied to personal models too. Where that type of modelling will probably come up short of a specially designed system like I showed you though, is that it won't then take account of tax rates and allowances in the UK. It won't show you your maximum spending capacity and loss capacity based on your other assets. It won't allow you to model historic volatility and how that can impact those assets. And it won't show your probability of success. All things that can add confidence to your financial planning. The important thing is though, knowing what's available to you. If you'd like more insight into how you can increase confidence when taking income from non-guaranteed pensions, like personal pensions and SIPPs, I'd recommend watching this video next. I hope that's been helpful, guys, and I'll see you next time.